Welcome to Subramani. Last week I was on a vacation and you guys couldn't hold the market, right? So you couldn't take care of the market when I was not here. Anyway, jokes apart, if you see the kind of headlines which we are seeing, saying, oh, 1% fall in the market, last 1 week has been the worst 1 week in the last 18 months or maybe 24 months, whatever. So picking up such data is very nice, and you should see all the headlines which maybe I'll go through. I'll find some of the headlines and I'll go through. So let's look at it this way. The recent fall till 7th of October is attributed to a lot of things, including domestic and global geopolitical tensions internationally. All these things are being attributed to the fall. Nobody attributed any of these things to the rise, right? So whatever it is, how much has been the fall? Has the fall been too much? No, it is perhaps wiped out last 1 month's gain, which means the index must have been around this much, around 81,000 or slightly under that, 80,000 and odd, sometime in August. So we are talking of perhaps August to October, which means the gains of September have been wiped out. In a bad market, gains of a couple of years have to be wiped out to call it a bad market. So this is a knee-jerk reaction, but expect every newspaper to say there has been a rout in the market and the market has been completely, the market has crashed, people have lost 10 lakh crores in this, Ambani is poorer by X amount, Adani is poorer by this amount. You're bound to see and hear all this. What you have to see is what is the impact on your portfolio. So what are the reasons why the market has gone down? Honestly, none of us know the real reasons. Only thing you can know for sure in any commodity, and equity is a commodity, is there are more sellers than buyers. There's not enough buying support for the share to be held up. Share, I mean the shares which are comprising the index. Of course, the fall in others could be much greater, could be lesser. I don't remember. I have not seen any of the specific prices of my portfolio, but that's fine. I'm not here to talk about my portfolio. So then, so global concerns, US data is not looking good. Geopolitical tensions, there is war happening, name it, and the war is happening in Iran, Iraq, what have you, right? So Israel is killing terrorists. Some people are celebrating that in India, that India is killing, that Israel is killing terrorists, and some people are mourning for the terrorists who are dead. So all these things are happening. So all these are the political tensions, whether it is in India or whether it is abroad. Obviously, Haryana elections are not going to be too good for BJP. Jammu, maybe they'll get some seats. Kashmir, they're not likely to get some seats. So politically also it's not a great thing happening for the ruling dispensation. Given the fact that China is rising, right? So China is rising, so institutional money will go from India to China. The trading money will definitely go. So how much of the investment money will go, one has to see. But obviously, if the data, if the markets in US are needing money because people want to invest in the US and people want to invest in China, it's fairly obvious that the FII money, which was a trading money, will reallocate more to US and China. So they will pull some money out from India. So that is the anticipation that they will pull money out is called market sentiment. So if everybody in the market feels that the FIIs will pull out, then it makes sense for me to sell today and wait so that when they pull out completely, I can buy it back, right? So that's just a feeling, it's just a perception. But also look at it this way, the market was already pretty high and all it needed is a small pin to prick the balloon. So is the fall over? I have no clue. Will the market go up further? I don't know. Now I'm sure some readers will say, if you don't know, why are you making a video? I think it's very simple. It's because I know I don't know, and some people don't know that they don't know. Therefore this video is being made. So what should you do in the market, right? That's the most important question. So what are the what are the things that you have to do? First, go and review your portfolio. Is your portfolio for the next 5 years, 10 years, 20 years, or permanently you're just into wealth creation mode? You have enough money for all your goals and you're creating wealth beyond that. So then you don't really need to react for everything that is happening on your full portfolio. Have a small trading portfolio, maybe 5% of your portfolio. If your portfolio is big, that itself will be a big amount, but that's okay. In your scheme of things, that does not really matter. With that, you can react to whatever is happening in the market. So the other good stuff that you carry, it just goes on and on. I mean, if I have some shares bought in the 1970s and I'm still holding, it is just creating wealth for me. So am I worried about the day-to-day fluctuation, week-to-week fluctuation? No, it does not matter. Is the interest rate scenario in India bad? I don't think so. We don't have too much of leverage. Our CD or current account deficit, our fiscal deficit, all are in control. Our markets are not doing badly. We are getting money. The business people are getting money from banks. If there is a shortage, they are able to place their own debentures out in the market at 9%, 8.5%, 9%, and able to get money. Maybe they'll place it at 10%, but they're still able to get money. Equity markets is willing to give money to anybody wanting to raise money, whether it is an OFS, IPO, or a private placement, right? All these markets are doing well, so there is no such thing. Yes, there will be a sectoral impact. If the money flows out, then some infrastructure funding could get delayed, some airports could get delayed, and things like that. Will 1 month change much? I don't think it will change much, right? So for long-term investors, it could be an opportunity to buy. I'm asking you to jump into the market and buy everything? Answer is no. Still an SIP kind of an approach could work. Let's say you pick up one particular share which was at 240 some time back and is now available at 185. Does it make it a great buy because it was at 240? Maybe no, maybe not at all. Maybe the best price for it is 150 or 160, which means there is still some fat to be burnt there, right? You want to buy it at 160 or 165. Maybe if the market was going up, you may have jumped in and said, okay, I don't mind buying it at 184. But when the market looks weak, you might as well wait for it to reach 160, or maybe you buy it at 155 or 140. You never know. I'm just saying one hypothetical share. I'm not having any particular share in mind, right? So these kind of opportunities will arise. You create your own portfolio and wait and see if the market sentiment is worsening. Hold on or buy a little bit. Let's say you want to buy 5,000 shares at of this share, and today it is available at 180. Maybe buy 100 shares, maybe buy 200 shares, and test the waters just to see what is happening. See how many people are buying, how many people are selling, and then slowly add on to it. Because if you want to buy a big quantity and this share is not available in big quantities, you may have to buy slowly. And being slow does not really matter in the market. Your direction has to be right. So if your direction is right, you don't have to worry too much. The immediate future for the Indian market may look a little scary because FIIs are selling and then the sentiment is bad, etc. But all other factors seem to be favoring India. So I did a television show. I think maybe I did a video clip also. I must have put it when I said everything is favoring India. We can't see the risk. Does not mean risk is not there. The risk that China will go up and therefore money will have to be raised by selling in India was not visible to anybody, right? Not even to people who are China watchers was it available as information. So those people who were short China and long India have lost both. They have lost money in India, at least the traders, and they have lost money in China. China went up fast and furious, some 18% jump in less than 2-3 months, maybe 4 months, right? That kind of a jump that happened. So technical analysts will be looking for support for, looking for the range of 23,250, 24,000 kind of a thing, 23,400 kind of a range on the Nifty, and perhaps there they will start buying. Well, now let us look at some of the headlines which people say. So they, I don't know who is this, is an Indian stock market faced a sharp decline with Sensex plummeting 4,000 points in 5 days due to the Iran-Israel war. Look at it this way, how much is 4,000, right? Now 4,000, it's not some, it's not as though the Sensex is at 20,000 and it has fallen by 4,000 points. The Sensex is at 84,000, it fallen by 4,000 points. It is still at 80,000, right? So let us look at what Business Standard is saying. Business Standard is saying India's benchmark indices fell nearly 1% on Friday, capping their worst weekly performance in over 2 years, right? So this is how you pick data and say it's the worst performance, the worst weekly performance in 2 years. Honestly, if you're a long-term investor, you will forget this week very soon, and then you will wonder what was Subra getting so excited about. I'm not getting excited. I'm just telling you, look at the headlines. Indian stock market faced a sharp decline with Sensex plummeting 4,000 points in 5 days. So FIIs have pulled out 32,000 crores and concerns about peak valuations pushing Nifty below key support levels. This is funny because I don't think the FIIs pulled out because of Indian valuation. They were still buyers, right? So, but in China gives you an opportunity, you have to go there. Indian stock markets are experiencing a deep sell-off, opening Friday in the red and extending Thursday's sharp decline, the worst since early August. Look at the way they look at the market for in October. They're saying worst since August. Now this is headline grabbing, nothing else. Marksman Daily, and then let's see what Mint has to say. I can't get the Mint one. Sher Khan says the benchmark clock worst drop in 2 months in October. Led by selling pressure across the board, right? In 2 months, it was the worst selling pressure. In Vikalp, it says Indian indices plummet. Indian indices plummet. Indian indices crash. Indian markets have pulled out. FIIs have pulled out 32,000 crores, right? So these are the kind of headlines which are going to hit you. If it makes you nervous, well, they have achieved their purpose of saying, oh, this is market is bad, so you should sell. The problem is for people with a leverage, they may have to close their positions because they don't have money to pay the interest, or they don't have money to take on more delivery. So some of those people will be hurt. If you are an investor, genuine investor, go and see what are your goals. Do you have any goals within the next 3 years, 4 years, 5 years? Then you might have to think a little. But if your goals are 10 years, 20 years away, just don't bother. Can the market go down further? Absolutely, it can go down further. So if you want to panic soon, right? You've lost just 4%. Then don't look at the Sensex. Look at your portfolio. See what your portfolio says. Thank you.